So this one's going to be about depreciation methods. And before we get into the methods, I want to just talk a little bit about depreciation itself. So as you can see here, depreciation does record the wear and tear or account for the wear and tear on a long-term physical asset, such as some type of property like buildings, vehicles, machinery, or equipment. Those are all physical long-term assets that do wear and tear when you actually use those assets. And while you're using those assets, you do have to account for the costs because you're using those assets to generate your revenue. So in order for you to know if you're profitable or if you are generating an income, you have to account for the expense or expense of using that physical long-term asset. So accounting for that comes from depreciation. So the three different types of methods that you can see here are your straight line method, double declining balance method, and also units of production method. Units of production method is used, I want to say, primarily used by factories that actually count on the actual units that's being produced to generate them revenue. All right. So straight line method is pretty common. It's prevalent. So a lot of companies use the straight line method. Plus, it's easy. Double declining balance method is a method that actually takes or records the cost, a good amount of the cost early on, and then towards the end of its useful life, the actual long-term asset useful life, the expense starts to decline. But early on, you pretty much are recording or taking that depreciation expense early on. All right. So one thing I want to note here also is that depreciation, let me put it over here if I can. All right. It is a non-cash expense. This means that when you record depreciation expense in your books, it doesn't take into consideration any cash movement or cash because it is a arbitrary expense that's actually being recorded in your books. So it's not technically cash that's going out. All right. So straight line method, I want to just show you all an example of that. So let me zoom in here, and this is already done. So I made up a company. It's called Goofy Tech Company Purchased Equipment that costs $96,000. The equipment's useful life is estimated at 15 years with a salvage value of $10,000. Okay. So before I actually get into this problem here, as far as what it's asking for, let's first dissect this scenario here. So it gives us three things that we do need to know in order for us to calculate the depreciation expense. So it gives us the cost of the equipment. That's $96,000. So that's one thing that we do need to know. We need to know the cost of the asset. Here is $96,000. And it gives us the useful life. The useful life is when the company is expecting to use this equipment. Okay, so it is expecting to use this equipment for 15 years. So they're expecting to generate some revenue or receive some benefits from this equipment for 15 years. Then it has salvage value or salvage value. All right, salvage value here is $10,000. So this means that the company thinks that after they use this equipment up for 15 years, they think that they can get $10,000 for it once they sell it. So they think that that's the salvage value. Now, it could, a company's equipment could be a zero or not worth anything, but you have to know what that value is. So that way you can determine what the depreciation expense will be. So in this case, $10,000 is the salvage value. That's how much they think they can get it for. So from here, and I know it's already done here on the left-hand side, but I want to actually do it live. From here, we can actually determine what the depreciation expense will be on a yearly basis. Okay, so since it's the straight line method, I'm going to put on here S-L. That stands for straight line. The formula to use for straight line method is we're going to take the cost, okay, of the equipment or long-term asset, physical long-term asset, minus salvage value divided by useful life. So we're just going to plug in what we see here, these three factors here. We're going to plug it into this straight line method formula. So we got 96,000, subtract out 10,000, which is our salvage value, divided by 15 years. Okay. So I already did, the answer is right here. The answer is going to be $5,733, and that's the depreciation for the year. Now let me go back up here to this formula here that has the amounts on here. So you notice the cost is 96,000, okay? But you also notice that this 96,000 is being subtracted from the salvage value. Okay, why is that? The reason why is because if you know that you can get $10,000 for it, which is the salvage value, then you cannot depreciate below $10,000. So essentially the depreciation begins with $86,000, and it's taking 96,000, subtract out to $10,000. Okay, so that's why we're subtracting the salvage value from the cost. Okay, so per year, $57.33. Now we go back up here to the problem. It says determine the equipment's third year depreciation expense and the book value of the equipment at year end. So we need to know what's the depreciation expense for the third year. Well, depreciation expense for the third year, let's go ahead and walk through this. So for period one, the depreciable cost is $86,000, which I mentioned that's the 96,000 subtract out $10,000. So we have to start with depreciation, recording depreciation expense from the depreciable cost, which is $86,000. Okay, so then we're going to subtract out the depreciation expense of $57.33, and that's going to pretty much give us, let's see, a year-end book value of $90,267. Okay, so you may be a little confused as to why is it $90,267 for the year-end book value. So with this example, this book value here is taken into consideration the $96,000. Okay, because that's how much the equipment cost. Even though the depreciation is being taken from this 86,000, it is the book value is going to take into consideration the $96,000, which is the cost. Okay, so we take the cost, subtract out the 5733. Okay, that's minus. All right, that's our accumulated depreciation. Okay, that's going to give us 90,267. Okay, so that's what matches that. All right, so as you can see here, the accumulated depreciation is 5733. Now we go to year two. The depreciable cost is still the same, 86,000. Depreciation expense is still the same. Okay, for year two, accumulated depreciation, it went up 11,467. That's because it's taken the accumulated depreciation from year one and added it to year two. Okay, that's what's giving you the 11,467. Then the year-end book value is going to go down now from 90,267 to 84,533. Okay, and that's taking that, again, the 5733, subtracting it for 90,000 from 90,267, the year one ending book value, to get 84,533. Okay. So this is the new book value going into year three, or the end of year two. So year three, depreciable cost is the same. Depreciation expense is the same. So technically that is the answer. Accumulated depreciation changes because now you're going to take 11,000 and add the 5733 to get your accumulated depreciation as of year three of 17,200. So then the year-end book value is going to be $78,800. And we just take the year three depreciation expense, and then we subtracting it from 84,000. That's going to give us $78,800. Okay, so I was going to actually do or include the double decline and balance method and the units of production method in this video, but I think that this video will be way too long, so I'm going to actually break it up into 2 additional videos.